you're there. I got an awesome one for you guys today. For some of you that don't know, I work with students and I train students how to make money in the stock market every single day. And there's a handful of reasons why people aren't successful on their own. Why 99% of all investors don't make money, and it kind of just seems like there's a handful of people, the top 1% of investors is what I call them, make money hand over fist every single day, every single week, every single month, every single year. I'm sure you felt that way too. Now, I see 3 big mistakes that are, I'm calling them painfully obvious. I see 3 painfully obvious mistakes that most retail, non-professional traders and investors are making day in and day out that prevent them from turning themselves into one of the top 1% of all investors. The good news is they're very, very fixable. So on this video, I'm going to go through these 3 painfully obvious reasons why investors fail and exactly how you can fix them. So this should be a pretty exciting one again because it's educational and it's very actionable. So at the end of this video, you will know the 3 painfully obvious reasons investors fail and exactly how you can fix them. So here we go. I'm already typing away. You guys are missing out. I'll see you guys inside the computer. All right, everyone, here we go. Inside the computer now. The 3 painfully obvious reasons why 99% of all investors fail. Now, there are 3 major ones. Again, they're all painfully obvious. They all cause people to not be able to make money consistently in the stock market. But they're all very easily fixable. So the goal of this video is to tell you what these painfully obvious reasons are. And I promise you, you're going to have a very similar reaction that I did in this photo on the right. You know, this is my reaction when I learned these 3 easy steps. I was like, okay. They're so obvious, yet I've never done them before. And that's the exact same reaction you are going to have after watching this video. You know, they're really, really easily fixable. And you're going to be like, oh, okay, yeah, I could easily change that. I could easily do it like that. And then you're really off to the races. So here we go, guys. The 3 painfully obvious reasons why 99% of all investors fail and exactly how we can fix them today. So here's the painful truth, guys, and I'm sure you kind of feel this way. Unfortunately, 99% of all investors fail. That's absolutely true. And it can be very hard on a person to lose their hard-earned money while watching the top 1% of investors make money every single day. Remember, these are 3 painfully obvious things that make individual investors lose money every single day. The top 1% of investors know how to avoid these, and at the end of this video, you will know how to avoid these as well. So that should be pretty exciting to you guys, right? So fortunately for you, the 3 common and obvious reasons for investing failure are easily corrected. They're super, super easily corrected. Now, we've done videos on all of them. We've kind of corralled them here, and we're going to hammer them home right here. Again, guys, these 3 common and obvious reasons for investing failure are easily correctable. Again, the 99% of all investors, they're doing these things wrong every day. The top 1% of all investors are doing them right every single day. My market heroes, they're doing them right every single day. And they're all easily fixable. All these 3 issues, super easily fixable. So the first reason why 99% of all investors fail, their trade size is too big. And it makes investors make emotional decisions, be undiversified, and does not allow our positions time to make a profit. Now, I have already made a video about this, which I will add to the description. I'll add a link to the description. But the number 1 reason why investors fail is because their trade size is too big, period. End of discussion. It makes them emotional. It doesn't allow them to be diversified, right? It does not allow them time. They don't give themselves time to be right. Think about it this way. Losing $500, losing $50. Which one are you going to be reacting more over? Probably losing $500, right? So at the same time, having too large an investment size does not leave very much cash on hand to jump on any opportunity that arises. If you have 4 or 5 positions and you're all in and you see a great opportunity out there, you might not necessarily have cash on hand to be able to jump on that opportunity. But if you have small trade size, you will be able to, right? And holding smaller positions prevents any one position from taking down the entire portfolio. And we'll see what that actually looks like here right now. So the math behind this first reason, which is trade size being too big. If we have a portfolio that has 5 positions in it, and each of those positions gets 20% of the value of the portfolio, and we decide to buy stock with each of those positions, what are the chances, mathematically speaking, our account goes busto or goes to zero? Now again, guys, this is not emotions. This has nothing to do with the fact that someone thinks a stock is going to go up forever. This has nothing to do with the fact of interest rates or balance sheets or charts or indicators like MACD. This is pure math. If we have 5 positions in the portfolio where we're long stock and each of the positions gets 20% of the portfolio, what are the chances the portfolio goes to zero? They're 1 in 32. Now, I don't know about you guys, but I would prefer not to have a 1 in 32 chance of losing all my money. I would prefer it to be a lot better. So let's take it a step further. If we have 10 stocks now, 10 long stock positions in the portfolio, so that each of the stock positions gets 10% of the total portfolio, now what are our chances that we lose all of our money? Well, they're 1 in 1,024. So obviously, from going from 5 positions to 10 positions is a huge advantage in terms of allowing us to stay in the game. But let's take it a step further. Now what if we have 20 positions, each with 5% of the total portfolio on each of the positions? Well, now it's better than 1 in a million, right? There's a 1 in 1 million plus chance that we would lose our entire account. That's the power of staying small, is that it allows us to stay in the game. If we stay small, we have very little chance of losing all of our money. We have a great chance of being diversified. We have a great chance of staying in the game. We have a great chance of having a lot of cash on hand, so if that opportunity rises, we can jump all over it. So now, the first problem is trade size is too big. How do we fix that problem? No single trade can use more than 5% of the entire portfolio. That's it. That's it. End of discussion. Not up for debate. That's it. No single trade can use more than 5% of the entire portfolio. Just look at it this way. Which would you rather? Having a 1 in 32 chance of your portfolio going to zero? Having a 1 in 1,024 chance that your portfolio goes to zero? Or having a 1 in a million plus chance your portfolio goes to zero? I'd rather have the 1 in 1 million plus chance my portfolio goes to zero. I want to be doing this for the rest of my life. I want to be making money and creating financial freedom for the rest of my life. The only way I could do it is if I have a portfolio. So no single trade can use more than 5% of the entire portfolio. So in a $2,500 portfolio, no one position can take up more than $125. In a $10,000 portfolio, no one position can take up more than $500. And in a $30,000 portfolio, no one position can take up more than $1,500. So, the first painfully obvious reason why 99% of investors fail is that our investment size is too big. How do we fix that? No single trade or investment can take up more than 5% of the entire portfolio. That's it, end of discussion. The second reason why 99% of investors fail, and I'm sure, guys, after talking about that first reason why they fail, you guys are starting to feel like, oh, hey, maybe that's been me. And you know what? I could fix that, no problem. The same thing's going to happen with this second reason. So the second reason why 99% of investors fail is the fear of missing out. That's right, the fear of missing out. Investors have a fear of missing out when stocks are going higher, so they buy it, and a fear of losing all their money when stocks go down, so they sell them. And this prevents investors from buying at the right time and selling at the right time. In short, they become pigs. If you guys remember this saying about investing in Wall Street, bulls make money. Those are those that bet that prices will go higher. Bears make money. Those are those that bet that prices are going down. But pigs, they get slaughtered. Those are those that are caught in between, that don't really have a game plan, that don't really have a rhyme and reason. When stocks go up, they buy them. When stocks go down, they sell them. And they end up giving their money away to the bulls and the bears. So, what we're looking at right now is margin debt levels compared to the S&P 500. And as we can see, the margin debt levels go up when stocks go up, and they go down when stocks go down. Now, what does this have to do with the fear of missing out?
Margin debt goes up when retail investors are borrowing money to buy stocks. So as you can see, retail investors are borrowing money to buy stocks as stocks are going higher. And they're getting rid of that money that they borrowed and selling stocks as prices go down. So this is completely opposite to buy low and sell high. This is buy high and sell low. And again, this is a great example of the fear of missing out. As stocks are going higher, as the news is talking about stocks breaking out to all-time highs, as your friends talk about all this money they're making in stocks, you go out there and you borrow more money at the wrong time. Here's another example. Total margin debt on the S&P 500. Now we're going back to 1980, and the exact same thing is happening that we saw in the last one. As stocks go up, people borrow more money. People borrow more money with the hopes that they'll be able to jump on the train, right? They have this fear of missing out, like, man, other people around me are making money. I got to go out there and buy more stocks as stocks go higher. Buy high and sell higher clearly doesn't work here. And another example, just another example, again, as prices go up, people borrow more money to buy stocks. As prices go down, people get rid of that money that they borrowed because they're selling stocks. So they're buying high and they're selling low when we should be buying low and selling high. So how do we fix this? Well, rather than buying stocks when they're up and selling stocks when they're down, this is an example of buying stocks when they're up and selling them when they're down. This is also an example of buying stocks when they're up and selling when they're down. This is also an example of buying stocks when they're up and stocks are down. Remember, people are chasing stocks up and running scared when stocks go down. Right? So rather than doing that, we need to buy stocks when they are down and sell stocks when they are up. Now, we've done a ton of studies to prove this. And there's another video that we've done that I will link in the description below that goes through all these studies about this. But what we've learned based off all of our studies, and we've gone back over 17 plus years to figure this out, if a stock is down greater than 5% over a 10-day period, it is far more likely that it reverses and goes back higher at a clip of 70% than it is to continue lower. So if a stock is down greater than 5% over a 10-day period, there is a 70% chance that it goes higher, and there's only a 30% chance that it continues to go lower. This is an example, rather than buying stocks when they're up and selling stocks when they're down, this is an example of buying stocks when they are down, getting in at a good price. That is how we fix the second reason why 99% of investors fail. The reason 99% of investors fail is because they have the fear of missing out. They buy stocks when they go up, they sell stocks when they go down. We want to reverse that. We want to buy stocks when they go down. And as a rule of thumb, if a stock is down greater than 5% in a 10-day period, there's a 70% chance that it goes higher and only a 30% chance that it continues lower. I want those odds on my side. The third reason why 99% of investors fail. When people buy stocks, if the stock goes up a penny, they make money. If the stock goes down a penny, they lose money. Pretty simple. Because of this, investors do not really have much better than a 50-50 chance to make money. If Apple's trading at $180 a share, it can only go up $180 and 1 penny or down $179.99, down a penny. Because of that, you don't really have better chance of 50-50 than making money when you buy or sell a stock. Now, the top 1 investors, the pros, and we did another video about this, so I'll link it in the description. The pros, they give themselves room to be wrong, right? If the stock goes down a penny, the 99% of investors, they lose money. However, if a stock goes down a penny, the big timers, right, the top 1% of investors, the pros, that doesn't necessarily mean that they lose money because they give themselves room to be wrong. So a strategy And again, we've done a video about this, so I'll link it in the description, but a strategy that allows investors to make money when they're directionally wrong is a put spread, which encompasses selling one put option and buying a put option further away. And we profit from this if the put spread is below the price of the stock when the option expires. So let's take a kind of a brief example and we'll show it. Let's go to SPY. And let's go to the monthly expiration cycles expiring 40 days from now. So let me hide all this stuff real quick. Just gonna hide it. I'm gonna hide it. Gonna hide it. So what we're doing on a put spread is we're selling one put and we're buying a put further out. So what this means is where if we bought SPY and it went down a penny, we would lose money. We would not lose money until SPY went below 261. This is an example, and again, I've done other videos on this. I will link them in the description. I don't want to get too much into them right now, but this is very, very fixable. Again, selling one put and buying a further away put, we don't start losing money on this trade till it gets below 261. But if we bought SPY for 265.50 and the stock went down to 261, we would have lost $450 for every 100 shares. However, in this scenario, we didn't lose a dime. And let's take a look at another example here, right? Fixing it. Again, we fix it by putting on something like a put spread, which gives us room to be wrong. So if we buy 100 shares of Snapchat, right, it would cost us $1,494. That would mean that Snapchat is currently at $14.94. If it goes up 5%, we make $74.70. Right, that's 5% on our money. And if it goes down 5%, we lose $74.70. That's 5% on our money. However, right, that's what the 99% of investors do. And this is the third reason why they fail. They don't give themselves room to be wrong. But if we sold a put spread, like the example we showed and the example that I'll link in the description, it's going to cost us $200. If Snapchat goes up 5%, rather than making just 5% on our money, we make 50% on our money. And if Snapchat goes down, rather than losing 5% on our money, we lose 0. And again, this gives us room to be right. And again, don't worry, I'll link in the description the other video that we did that goes into depth on put spreads. So, takeaways, guys. The 3 painfully obvious reasons why 99% of investors fail and how to fix them. And what's so exciting to me is I know a lot of you feel like these painfully obvious reasons why 99% of investors fail, you have done as well. And what's so exciting is here it is, right in front of you, how you fix them. So the first painfully obvious reason why 99% of investors fail is their trade size is too big. How do we fix that? No one position can use any more than 5% of the entire portfolio. Now, it can use less than 5%. However, no single position can use more than 5% in the entire portfolio. You have officially fixed the first painfully obvious reason why 99% of investors have failed. The second reason is investors have the fear of missing out. Remember, as stocks go up, margin debt increases, which means people are borrowing money to buy stock as stocks go up. That does not get them in at a good price. And when stocks go down, margin debt goes down because people are selling their stock. How do we fix this? When a stock is down more than 5% in a 10-day period, we buy it. The reason we buy it is because there's a 70% chance that the stock will go higher and only a 30% chance that it will continue lower. So the second painfully obvious reason why 99% of investors fail is that they have the fear of missing out. How do we fix it? We buy stocks when they're down. You've just fixed that. So you fixed the trade size being too big and you fixed the fear of missing out. Now, the third painfully obvious reason why 99% of investors fail is not having room to be wrong. And remember, guys, we did that example. Just buying Snapchat. What happens when we're down 5%? We lose 5% of our money. Or putting on something like a put spread. When we're down 5%, it doesn't mean we've lost any money. In fact, when the stock goes against us by 5%, we lose $0. So we can utilize a strategy like a put spread that allows you to be wrong and still make money. Okay, guys, take a screenshot of this, print it out, put it wherever you want. I'm going to link to all the different content I have about this below. But again, guys, here are the 3 painfully obvious reasons why 99% of investors fail and exactly how you guys can fix them. I want you guys to understand the gravity of what we just talked about. I want you guys to watch this video a million times so you get it. If you fix these 3 painfully obvious reasons why you and the 99% of investors are failing, you will turn yourself into a top 1% investor. And you will absolutely crush it.
So there you have it, folks. The 3 painfully obvious reasons why 99% of investors fail and exactly how you can fix them. Now, I hope you guys are excited as I am. These are some obvious things that are really fixable, which is so exciting to me because, again, if you fix these 3 things, you will have taken yourself out of the 99% and put yourself in the top 1%. You will have turned yourself into someone who struggles making money to someone who can easily make money. So I hope this was super exciting for you guys. Hit me up in the comments below if you have any questions. I'll link to all the other content I have about this stuff. But again, guys, the 3 painfully obvious reasons why investors fail. Number 1, trade size is too big. The way to fix that, no investment can be greater than 5% in your entire portfolio. Done. The second reason, the fear of missing out. The way you can fix that, when stocks are down greater than 5% in a 10-day period, they have a 70% chance of going higher and only a 30% chance of going lower. So you buy them then. Second reason, done. The third reason, you don't give yourself room to be right. When you buy stock outright and the stock goes down a penny, you lose money. You have to give yourself room to be right. A simple strategy to do that is a put spread. And I showed you guys how to do that in the video. Again, you do those 3 things, you've taken yourself out of the 99% of investors, and you've added yourself indefinitely for the rest of your trading career in the top 1%. I'll see you guys in the next video.